Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So, I want you to imagine for a second that you are running a multi-billion-dollar aerospace company.
Okay, high stakes. I like it.
Right. Very high stakes. You have this cutting-edge satellite. It is sitting in a clean room, fully assembled. The launch window is, rapidly approaching, and you have millions of dollars in capital just tied up.
Right.
But you're completely paralyzed. You can't move. And why? Because a tiny, $50 valve from a third-party vendor halfway across the world is delayed by 6 months.
Oh, man, that is brutal. But honestly, that paralyzed state is kind of the everyday reality of the aerospace industry right now.
Yeah, exactly. The whole operation just grinds to a halt.
It really does. The supply chains are just incredibly fragile. But today we are looking at a company that is systematically eliminating that exact problem. And the market is violently waking up to this reality.
Violently is definitely the right word for it.
It is. I mean,
Right.
just recently, Rocket Lab reported their first quarter earnings for 2026, and the stock just blasted up 34% in a single trading session.
Which is insane. I mean, if you are holding this stock right now, you might be staring at that massive one-day pop and your fingers probably hovering over the sell button to take profit.
Oh, absolutely. It's so tempting.
Because normally, chasing an asset after a 34% run is a fantastic way to get burned. We need to figure out if this is just a flash in the pan, like a temporary hype cycle driven by retail traders, or if we are actually witnessing a permanent fundamental shift in how this company is valued.
All right, let's move into the wealth building context.
So, a massive jump is thrilling for day traders, sure, but you and I are looking at this for sustainable, long-term portfolio growth.
Right, the bigger picture.
Yeah. So what is the fundamental shift here that actually justifies this kind of attention?
Well, to understand the wealth building potential over, say, the next 5 to 10 years, you really have to throw away the old narrative entirely.
Okay, what do you mean?
Well, if you think Rocket Lab is just a company that, builds rockets and shoots them into the sky, you are missing the entire thesis.
Because that's what everyone assumes, right? They hear Rocket Lab and they think of launches.
Exactly. But launching payloads into orbit is a brutal, super capital-intensive, low-margin business if that is literally your only revenue stream.
Right, you're just a delivery truck at that point.
Yes. And they were rapidly shifting from being a pure-play rocket launcher to an end-to-end space infrastructure prime. This is all about capturing revenue across the entire satellite value chain.
Okay, space infrastructure prime sounds great, very flashy in a press release, but let's translate that into actual business mechanics. What does that mean for an investor's bottom line? Are they panning for gold, or are they the ones building the railroads and selling the pickaxes?
That's a perfect analogy. Wealth is built on infrastructure, not just speculative missions. Think about the food delivery business.
Okay.
Most traditional space companies operate a lot like Uber Eats. They don't actually make the food. They just pick it up and deliver it to the destination.
Right, and as we know, the profit margins in pure delivery are pretty terrible.
Exactly. They're razor thin.
Yeah.
So Rocket Lab looked at that model and basically realized it was a dead end. So they essentially bought the farm, hired the chef, and now they own the whole restaurant.
Wow, so they control the whole thing.
They do. If there's a sudden shortage of tomatoes, they don't care because they grow their own. They aren't just giving a satellite a ride to orbit anymore. They are designing the spacecraft, they're building the physical satellites, writing the software that runs them, manufacturing the communication systems. They build it, launch it, and operate it for the customer.
That is a completely different business model. I mean, if you control the entire supply chain, you are capturing revenue at every single stage of a satellite's lifespan, not just the, 10 minutes it takes to get it off the launch pad.
Exactly. It completely changes their earning potential. Now let's look at the fundamentals.
Yeah, because we can sit here and talk about owning the restaurant all day, but if the restaurant isn't making money, the whole narrative falls apart pretty quickly.
Very true. But the Q1 numbers absolutely validate this new narrative. We aren't going to throw a massive spreadsheet at you, but if you only remember one number today, make it 68%.
All right, 68%. Let's unpack why that specific number matters so much to the thesis.
So 68% is the portion of their total revenue that now comes entirely from their space systems segment.
Wait, really? Just the systems?
Yes. That is the satellite manufacturing, the software, the highly technical components, out of $200.3 million in record quarterly revenue, which, by the way, is up 63.5% year over
That's
year.
a huge jump.
Huge jump. But out of that, a massive $136.7 million came from space systems. The launch segment, the actual rockets, only brought in $63.7 million.
Oh, wow. So the script has completely flipped.
Completely overshadowed. They are now a high-tech space manufacturing company that just happens to own an in-house delivery service.
That pivot is staggering, and it has to completely change their margin profile, right? I mean, building and licensing high-end software systems carries significantly higher profit margins than building a massive metal tube full of explosive fuel and dropping it into the ocean.
Precisely. Their GAAP gross margins hit a record 38.2% in the quarter.
For heavy manufacturing, that's incredible.
It is a massive leap. And they've built a fortress balance sheet to protect this whole transition. As of the end of March, they are sitting on $1.205 billion in cash and cash equivalents.
Okay, that's a serious war chest.
Oh, it gets better. Total liquidity is actually over $2 billion, and they've aggressively reduced their debt. The convertible notes are down to just $36.8 million.
Okay, wait, hold on a second. We just praised their margins and this massive cash pile, but I'm looking at the broader picture here. Their free cash flow is still negative. They burned through $77.4 million this quarter.
Right. It was a heavy usage quarter.
Yeah, I mean, sure, $1 billion in the bank is a great buffer, but bleeding almost $80 million in 3 months is a glaring red light for anyone prioritizing capital preservation. How do you justify calling this a safe infrastructure play when the cash burn is still that heavy? Where's the competitive moat?
It is a very valid concern, I hear you. But you have to look at what that cash burn is actually buying them. That money is funding an incredibly deep competitive moat built on vertical integration.
Okay, so it's not just wasted OpEx.
Exactly. They aren't just burning cash on administrative bloat. They're systematically acquiring their own supply chain to eliminate those bottlenecks we talked about earlier.
Right, the $50 valve problem.
Yeah, exactly. So they acquired Mynaric to bring optical communications in-house. They were acquiring Motiv, which brings robotics in-house. They even developed their own Gauss electric satellite thrusters completely from scratch.
So they are actively insulating themselves from the broader supply chain chaos.
That is the goal. And the second pillar of their moat is mission heritage. They have 87 successful launches under their belt.
That's a lot of flight data.
It is. They have proprietary hardware operating right now on Mars rovers and the Artemis missions. For defense or commercial customer, that flight heritage is basically an insurmountable barrier to entry for any new startup trying to compete.
You know, it's really the Apple ecosystem playbook, just applied to space.
Ooh, I like that comparison.
Think about it. Apple realized decades ago that relying on third-party hardware and software left them incredibly vulnerable. So what did they do? They built their own silicon, their own operating systems, their own glass.
Okay, back that all down.
Exactly. By controlling the entire ecosystem, they created incredibly high switching costs. If you are a massive defense contractor and Rocket Lab is building your satellite, coding your operational software, and launching your rocket, you are locked in. You aren't going to pull out and go to a competitor just to save a few $1,000s on a solar array. The risk of mission failure is simply too high.
Spot on. That brings us to the catalyst timeline.
Because the market is always looking, 6 months into the future? What are the actual events on the calendar that could move the needle here?
So the most immediate event is Q2 earnings coming up. The company issued forward guidance of $225 million to $240 million in revenue.
Okay, and how does that compare to expectations?
Well, the midpoint of that range easily beats the consensus estimates. So we are looking at a heavily telegraphed beat and raise scenario. Beyond earnings, the closing of that Motiv acquisition is huge. It instantly expands their addressable market by bringing those Mars-proven robotics fully in-house.
That makes sense. And what about the macro environment? Because defense appropriations seem to be a major factor here.
Oh, there are massive macro tailwinds right now. Take the Golden Dome missile defense project, for example.
Right, I saw that.
Rocket Lab was selected for this national defense initiative alongside legacy defense giants like Raytheon. As those government appropriations flow through, that funding directly bolsters their backlog. And defense spending is incredibly sticky revenue once you get your foot in the door.
Right. Once you pass the security clearances, they rarely kick you out. But let's look at the biggest hurdle on their calendar, the neutron rocket development.
Oh, yes, the big one.
This is their next-generation heavy-lift vehicle. It's designed to compete directly with SpaceX. They've been pouring capital into developing it. But we see a lot of PR about upcoming visual hardware milestones, like hot fire tests for the Archimedes engine.
Right, a lot of flashy videos.
Exactly. But I have to push back here. Does the market actually care about visual proof of hardware integration? Showing off a shiny engine in a test facility doesn't generate a dime of actual launch revenue. Why should an investor care about a test?
Well, in traditional software tech, testing doesn't pay. You're right. But in aerospace, visual hardware milestones are massive sentiment and financial catalysts.
Really? Just from a test?
Absolutely. When an institutional investor sees a fully integrated second stage or a successful hot fire test of an engine, it dramatically changes their internal financial modeling. It transitions the project from a theoretical engineering risk to a tangible asset. It proves the engineering is real, which physically de-risks the forward-looking valuation models.
Okay, so it removes the vaporware label.
Exactly. Now let's pivot to the chart.
Because the price action over the last few weeks has been, well, fascinating to watch.
The bullish momentum is violent. We are looking at a stock that recently pushed to around $105.36.
Which is wild.
It is. To put that in perspective, this stock has quadrupled over the past year. It broke out of a 52-week range that was sitting between roughly $20.89 to over $105. The move from pre-earnings levels of around $78 to where it is now implies a structural gap up.
But if you're an investor, chasing a stock at multi-year highs can be incredibly dangerous.
Always.
When an asset quadruples in a year and blasts through resistance like that, the immediate fear is that we are looking at a parabolic blow-off top. Are we just seeing retail traders indiscriminately hitting the buy button out of FOMO? Because that almost always precedes a massive correction. Or do the technicals suggest there is a structural buy-the-dip psychology taking hold that is establishing a new, higher support base?
The volume profile strongly suggests it is the latter.
Really, a new floor?
Yes. When a stock gaps up on this kind of massive fundamental news, the 68% revenue shift to space systems we discussed, it is usually institutional money aggressively repricing the asset.
Ah, so the big players are stepping in.
Exactly. They were underweight, and now they're forced to buy in to match the new reality. That institutional buying creates a robust support base. The minor drawdowns get immediately bought up by funds trying to build a position, which establishes higher lows rather than a catastrophic blow-off top.
So what does market sentiment look like?
Well, the mood is overwhelmingly bullish. Yeah. Everywhere you look. The analyst upgrades are just rolling in. TD Cowen raised their target to $120.
Wow, 120.
Yeah. And Citizens raised to $95. And retail flow is absolutely surging. If you look at platforms like X and Wall Street Bets, the stock is just dominating the conversation.
Retail investors always love a good space narrative, though.
They do. They really do. But there are two speculative catalysts that are adding serious fuel to this fire.
Okay, what are they?
First, there is an unconfirmed teaming up with the defense giant Anduril. The implications of that are huge. And second, there is the impending SpaceX IPO.
All right, let's zone in on that SpaceX IPO, because I think this is a critical psychological factor in the market. Is it possible that what we are seeing right now is just a massive halo effect?
It's definitely a question people are asking.
Right, think about it. Billions of dollars in speculative retail capital know the SpaceX IPO is coming, but they can't buy it today. Are they just rotating into Rocket Lab as a proxy play? Because if they are, that capital isn't loyal to the 68% fundamental shift. It's just parking itself in the closest available narrative, and it could evaporate the second SpaceX actually goes public.
It's a smart observation, and proxy investing is absolutely happening in the short term. Retail money definitely parks in the closest available theme.
Right.
But institutional money does not park billions of dollars in a proxy play just for a temporary halo effect. They are buying the tangible, verified $200 million quarterly revenue.
That's a fair distinction. But what about the internal sentiment? Because I noticed something digging through the Q1 numbers. There was a one-time stock-based compensation charge related to the CEO's canceled restricted stock units, or RSUs.
Yes, the RSU cancellation.
When you see executive compensation charges get shifted around, you immediately question if management is, cashing out at the top while retail holds the bag. How does canceling RSUs signal long-term alignment?
You have to look at the mechanism of what actually happened there. Usually, executives get RSUs, which are basically free shares, just for staying at the company for a certain amount of time. It's a simple retention bonus.
Right, golden handcuffs.
Exactly. By canceling those guaranteed shares and restructuring the compensation package, the board and the CEO are tying future payouts to highly ambitious, specific performance milestones.
Oh, I see.
The CEO is essentially saying, I do not get my massive payout unless I drive the stock price significantly higher. It completely aligns his personal wealth creation with the long-term wealth of the shareholders.
Now let's talk about the risks.
We definitely need to.
Yeah, let's ground this thesis because nothing goes up in a straight line, and the current valuation is incredibly demanding. They are sitting at a $45.4 billion valuation.
A big number.
It's huge. At that level, flawless execution is already priced in. The market is assuming they will not make a mistake. And the absolute biggest landmine sitting in front of them is the Neutron rocket.
No question. It is the ultimate make-or-break vehicle for their next phase of growth.
The entire valuation assumes the Neutron debuts successfully and starts taking market share. But aerospace engineering is notoriously unforgiving. Timelines slip all the time.
They do.
If the Neutron launch is materially delayed beyond 2026, their period of heavy cash burn extends indefinitely. They are already projecting Q2 operating expenses at $126 million. If Neutron slips into 2027, that cash burn becomes a massive liability, and the market could punish the stock with a swift, brutal derating.
The execution risk on Neutron is very real. I won't deny that. But remember that $2 billion liquidity war chest we discussed? That cash pile is the shock absorber.
Okay, so it buys them time.
Exactly. Even if Neutron is delayed by a year, they have the capital to absorb that $126 million quarterly burn rate without facing immediate insolvency.
Yeah.
And crucially, without needing to dilute current shareholders by issuing new stock at depressed prices.
Okay. The balance sheet protects the timeline, that is fair, but there is a secondary financial risk here, margin compression.
Let's hear it.
We celebrated their record 38.2% gross margins earlier, but if you read the fine print on their Q2 guidance, they're actually projecting those GAAP gross margins to drop down to somewhere between 33% and 35%.
Right, due to the mix shift.
Exactly, a mix shift toward lower margin government contracts. If they're fueling top-line revenue growth by taking on less profitable work, doesn't that significantly delay their path to absolute profitability?
You are right to point out the projected drop, but you have to understand the mechanics of defense contracting. Those initial government contracts are essentially loss leaders.
Loss leaders, like in retail.
Sort of, yeah. You deliberately accept a lower profit margin up front to prove your capability, get integrated into a massive multi-year government architecture, and build your manufacturing scale.
Oh, so you get your foot in the door.
Exactly. As you build the 10th, 20th, and 50th satellite for that exact program, your maturing subsystems drive the cost down. The margins expand dramatically on the back end. You sacrifice a few points of margin today to lock in billions in high-margin recurring revenue for the next decade.
So with everything on the table, what's the final verdict?
Well, we've walked through a lot. The massive Q1 revenue pivot, the shift to an end-to-end infrastructure prime, the technical breakout, and of course the Neutron risks. Based on all the current metrics and research, the core verdict here is a bullish score of 8 out of 10.
An 8 out of 10.
Yes. The fundamental thesis has been entirely validated by this latest earnings report. Rocket Lab is no longer a scrappy niche player. They are a formidable space infrastructure prime, sitting on a $2.2 billion backlog. Their vertical integration strategy is working beautifully, allowing them to capture revenue across the entire lifespan of a satellite.
So for the practical investor listening right now, you need to look at this with a multi-year time horizon. We are talking about a 12 to 24-month window at a minimum. You aren't buying this to flip it next week.
Definitely not.
You are taking a position to wait for the full commercialization of the Neutron vehicle and the massive scaling of those vertically integrated space systems contracts.
That is when the true sustainable cash flow generation actually begins. The thesis requires patience, but the structural foundation they have built is incredibly robust.
Before we wrap up, I want to leave you with a thought to mull over. People love comparing the modern space economy to the early days of the internet. If that is true, you have to ask yourself a critical question as an investor. Are you trying to guess which flashy websites are going to be popular in 5 years? Or are you looking for the companies laying the literal fiber optic cables in orbit, ensuring that whoever wins, they have to pay a toll? Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Well with Joshua episode.